Hello students, today I would like to welcome you all to this video. In this video we are going to learn about the bank reconciliation statement. So let's start. So the bank reconciliation statement, before we move on to this statement, I would like to share with the students that what is the purpose of preparing this bank reconciliation statement. So the purpose of preparing this bank reconciliation statement is to reconcile the balance of cash book, means the bank account that we prepare. In the cash book we make a bank column, so the cash book bank balance, cash book bank balance with the bank statement balance. So the bank statement is the document that we receive, so that will be the bank statement balance. So the bank statement is the statement that we receive after a certain period that contains the business bank account transactions that is prepared by the bank. So I would like to write down the differences here. So the cash book is the book that we prepare, in which we make the bank account, and similarly our bank, they prepare our account, and the bank, they prepare our bank account in bank statement. So the document that will be issued from the bank is the bank statement. So there are some differences that students must understand. So the number one, once we deposit any amount of money into the bank, so the deposits we record in the cash book as debit, because bank is our asset and our asset goes up, so we have to record it on debit side. And if there is any withdrawals, means any amount that we withdraw from our bank account, or any payments you can say, we record it as a credit, because our asset is going to be decrease. On the other hand, in the bank statement, the bank is crediting once we deposit the amount, so they do the opposite. The reason behind, because we are the customer of bank, if we give some money to the bank, they are supposed to pay us back. So any amount that we have in our bank is a liability of bank. So once we deposit the amount of money, that liability goes up, means bank has to pay us more. So that's why they are crediting. And if there is any withdrawal, means we took some amount of money, or we pay some amount of money from our bank account, the bank, they do debit, because their liability is decreasing. Similarly, if we have a positive balance of bank account, so positive balance, so we have that on debit side. And if we have an overdraft, means we withdraw some more amount of money from our bank account, so mean a negative balance. So if we have an overdraft negative balance, that comes on credit side. On the other hand side, in the bank statement, a positive balance will be shown as credit balance, and if there is any overdraft balance, so that will be shown as debit balance. So that's what do we need to understand the differences between the cash book and the bank statement. Now, as we have seen that the purpose of bank reconciliation is to reconcile the balances of the cash book and the bank statement. So means there is a difference between the cash book balance and the bank statement balance. So why do we have these differences? I'm going to write down here the reasons of the differences. So there are some transactions so that will be the reasons of differences. So there are some transactions. Okay, so there are some transactions that recorded in the bank statement and not recorded in the cash book. So I usually say that this is the step 1, that we have to identify these differences and we have to record in the cash book and find out or calculate the updated cash book balance. So first step is we have to find out the differences, the transactions, those are recorded in the bank statement and not in the cash book. So once we got those transactions, we have to update our cash book first. So that's the first step. So the next difference or the next step is the step 2, we can say, is to find the difference. So there will be some transactions that will be or that already recorded in the cash book but not in the bank statement. So there will be some transactions that will be in the cash book but not in the bank statement. So for those transactions we will record these transactions into bank reconciliation statement. So there will be two types of differences. So one type is already that will goes to the updated cash book, and the second one, those transactions that will goes to the bank reconciliation statement. Now there are two types of entries that we have for the step 2. Like if there are some deposits that we make into the bank account, so the bank deposits not showing in bank statement. So we name them as uncredited. So we called uncredited checks. Let me write down here for you guys. So it's called uncredited checks. And if there are some payments, bank payments or withdrawals not showing in bank statement, is called unpresented checks. So these two things will goes into the bank reconciliation statement. Now there is one more thing, and that is bank transaction errors. So we need to remember that if there is an error from our side, if there is an error in cash book, so that will be corrected in cash book. Or if there is an error in the bank statement, that will be corrected in BRS, bank reconciliation statement. So that's the main thing that we have to understand while answering the question of bank reconciliation statement. Now if we are going to make the bank reconciliation statement, so there are two formats that we can have. So first thing, the BRS, after updating the cash book, obviously once we have to update the cash book balance, that's the step one that we have already learned. The next step is preparing the bank reconciliation statement, or either we can start from the balance as per cash book. So if we start with the balance of cash book, so we need to have this updated cash book balance. So this updated cash book balance can be in the positive or in the negative number. So if we have an overdraft, we will write down the negative number. So if we have a positive balance, we will write down as a positive balance. That needs to be adjusted with, so we are going to less uncredited checks, means the checks that we already deposit into the bank account, but it is not showing in the bank statements, as it's already added here because it's deposit and it's shown in there. So we'll deduct this from this balance. So after doing this adjustment, we will have a balance, and then we will add unpresented checks. So these are the checks of the payments that we made from our bank account, but it is not showing in the bank statement. So we'll deduct this from this balance. We will add this into this balance, as we already deducted this from this side, this cash book balance. So we'll add them back to get our balance, and that will be the balance as per bank statement. So this is the purpose, or this is the way how we reconcile the balance. So now this balance will be equal with the bank statement balance, or there can be another format in which we have to start from the balance of bank statement. So that will be again a positive or a negative number. If we have a debit balance, so it means in the bank statement, if we have a debit balance, it's a negative balance. And if we have a credit balance in the bank statement, means we have a positive balance. So we have to be very careful with this one. Now from this format to this format, so there will be a mirror effect. Like if we are here less uncredited checks, so there will be add uncredited checks. Means those figures that we deposit into the bank account is not showing in the bank statement, so we have to add them here, and then we have to deduct less unpresented checks. So we'll deduct this from this number to get the balance of cash book. So there will be a balance as per cash book updated. So this balance will be the same balance that we'll have from the updated cash book balance. So that's what we have in our bank reconciliation statement. So first of all, I'm going to repeat this step. So here's the step 1, so that we have to identify the transactions those are not recorded in the cash book. So we'll do that and we'll record them and make the updated cash book balance. And the second step is we have to identify the amounts or transactions that is recorded in the cash book but not in the bank statement. So we'll make the bank reconciliation statement. Anything that we deposit not showing in the bank statement we call uncredited checks, and any payments that is not showing in the bank statement is called unpresented checks. So if we have some errors, so errors will be corrected in the cash book. If there is a error in the cash book, so that needs to be corrected in the cash book, and if there is an error in the bank statement, that will be corrected in the bank reconciliation statement. We'll see that once we are going to solve a question. I'll show you how we're gonna do that. So this is the format that we have. If we are going to start from the balance as per cash book updated balance, so we'll follow this, means less uncredited and add unpresented. And if we are going to start our bank reconciliation statement from the bank statement balance, and then we will add the uncredited checks and we will deduct the unpresented checks. In the next video I will show you some questions, the questions of BRS. So how we're gonna do that, how we're gonna solve that. So thank you very much. If you have any comments or any suggestions, please write down in the comments box.